You get a 5% raise at work. You keep your emergency cash in a savings account paying 3%. You use a sleek, zero-fee app to send money to family overseas. On paper, you are making all the right financial moves. Yet, month after month, the math stops working. The grocery bills bite a little harder. The vacations get downgraded. Despite earning more and saving consistently, your actual purchasing power is dropping. This phenomenon relies on a psychological blind spot known as the nominal illusion. We are conditioned to trust the printed digits on our currency and the balances on our screens, rather than measuring what that money is actually worth. Real value is the measure of what those digits can buy in the physical world. When we focus on the face value rather than the purchasing power, we leave a gap. That gap is where institutions quietly siphon off your wealth. To actually build wealth, you have to look past the comforting numbers on a bank statement. You have to learn to see the invisible economic mechanics designed to drain you. Let's look at a standard financial scenario, a mechanic called bracket creep. Your employer gives you a 5% wage increase. In that same year, the broader economy experiences 5% inflation. In theory, you break even. But tax brackets do not always adjust for inflation. As your salary rises in nominal terms, your income spills over a threshold and into a higher tax bracket, increasing the average rate you pay. This chart tracks exactly how this mathematical trap plays out. As the nominal wage line rises over time, inflation tracks right alongside it. But watch the real post-tax income line. It diverges, diving sharply downward. Look at the expanding space between the rising wage and the dropping real income. That gap is a hidden tax increase. The government collects a larger slice of your purchasing power, and lawmakers never have to hold a vote to raise your taxes. A similar mechanic targets the money you hold in the bank through a policy known as financial repression. Governments deliberately cap deposit interest rates and tightly regulate capital to push borrowing costs down, creating an environment where nominal returns fall completely below the rate of inflation. In the years following the Second World War, the United States relied on this exact strategy. By keeping interest rates strictly suppressed while inflation ran hot, the government successfully inflated away the massive sovereign debt accumulated from wartime mobilization. The math applies exactly the same way to a retail savings account today. Earning a 3% yield during a year with 6% inflation means your money is shrinking in real terms. It is a stealth tax, transferring wealth directly from private savers to government borrowers. The extraction extends far beyond government policy. When you use a digital service to send cash overseas, banks heavily market their zero-fee transfers. This equation breaks down the actual math behind international remittances. The true cost to you is the sum of three elements: the sending fee, the exchange rate markup, and the receiving fee. The banks happily drop that sending fee variable to zero. In exchange, they massively expand the exchange rate markup, often bearing a 2 to 3% margin directly into the conversion, while SWIFT intermediaries deduct additional handling fees in transit. This extraction becomes most aggressive at the bottom of the income ladder. There is an assumption that living on a low income means having fewer expenses, but lacking capital actively attracts higher costs. Individuals locked out of the traditional banking system rely on alternative financial services. They pay steep percentage cuts simply to cash a paycheck and face compounding double-digit interest rates when taking out short-term payday loans for emergencies. The physical environment compounds the friction. Cheaper, older vehicles require constant maintenance. Neighborhoods lacking full-service supermarkets force residents to buy basic groceries at inflated prices from convenience stores. Contrast this reality with high net worth consumers. They channel their spending through reward credit cards to generate profit, leverage asset appreciation, and hire professionals to execute tax minimization strategies. The modern economic system assesses structural penalties on those without capital. Poverty operates as a tax of its own, extracting wealth from the very people who have the slimmest margins. The global economy functions as a massive, continuous conveyor belt. It grinds down those who blindly trust nominal numbers and transfers their purchasing power to those who calculate real value. To survive this environment, you have to benchmark every transaction against its base cost. For a bank transfer, that means checking the raw mid-market exchange rate before you send a dollar, instantly revealing the hidden markups. Because cash savings guarantee a loss against inflation, preserving purchasing power requires assets that historically outpace financial repression. Consistent, systematic investments in broad equity markets provide a proven yield above the inflation rate over decades. Investors also turn to physical commodities. Tangible assets operate entirely outside the nominal illusion, carrying inherent value that historically preserves purchasing power across generations. The taxes and fees that destroy your wealth the fastest are the ones never printed on a receipt. Ultimately, true financial literacy is mastering these invisible mechanics, ensuring the purchasing power you earn doesn't silently slip away.